Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. Okay, so we're coming up on 6:29, so I'm going to say hello, and there's 6:30. So I like to start on time. We're gonna go for about an hour and a half, maybe. If we, it depends on how many. Are you comfortable? How are you with that, David?
Well, yeah, whatever you want.
Yeah. Okay. So I want to welcome everybody. This is our special webinar series, 6:30 on Wednesdays. Not to be confused with our regular Tuesday 10 a.m. webinar that you're welcome to join us. Me anyway, Dave won't be there every week. But we have David McKnight here, and David is the best-selling author of The Power of Zero, Tax-Free Income for Life, and Look Before You Lerp, and at least one other book, David. I'm sorry, it's escaping me. What's
Volatility Shield?
The Volatility Shield, yes. I'll talk more about that, and I'll give, I'll officially introduce Dave, but we were talking, and I'll just share with you that I keep a library of Dave's books here and send them out to people on a regular basis because it just helps me tremendously carry the message that that is so important to folks when they're planning for retirement, and that is we've got to focus on tax rate risk, longevity risk, in addition to market risk and long-term care risk. And unfortunately, most financial advisors are focused really on that market risk. Sometimes the longevity risk, hardly anybody, the tax rate risk. But what I really enjoy about Dave's books, and I say that even if he's not here, is the message is really clear. It's really enjoyable. The reads are really short and easy for all the information in here. When I got this book, I read it in a couple hours on a plane ride home, The Power of Zero, and I'll tell you more about that. But it also motivates you. I think you'd be hard pressed to read this book, put it down, and not feel like I have to do something. And motivation is really important, and keeping that momentum going is really important. So I appreciate the work you've done, Dave, because you certainly make my job easier. So welcome everybody. I want to remind you just a couple of householding things, that everyone is muted. We do have a Q&A option right at the bottom of your screen. Most of you are probably used to this by now. You can click into Q&A and type in your question, and don't wait until the end, or don't wait for us to cue you to ask questions. Ask questions as we go, because we'll come back and view the questions. And if they get answered, so be it. You can say, I already got it answered. But if you try to wait, often you forget. So just go ahead and put it in there. It's kind of a casual conversation. David and I are going to talk about a few things, but we're going to certainly entertain questions, and we're happy to answer those. Chat, however, is disabled. That's a odd regulatory requirement. We can have Q&A, but we can't have chat. Don't know why, but that's the situation. And this meeting, this presentation is recorded. So I want to welcome David McKnight. I want to welcome all of you tonight. I shared with you the books I keep in my library for David. I just talked about that. David has a new book that was just published, a few months ago now, Dave?
Yep.
Okay.
November.
Yep. You can get this on Amazon, certainly, and order your copy. And at the end of this webinar, you're going to have an opportunity to book a time with me. So if you have questions that pertain to you, if you've got any burning issues you want to review, I have blocked out time over the next several days. So 3 or 4 days, I've cleared a few hours of time each day, and you'll have an opportunity to book time with me to be able to answer those questions. And there's no obligation, there's no cost to this time. You'll have 50 minutes, 50 minutes to answer the questions you have, and then we'll decide if it makes sense to go forward. And if you book an appointment and you want a copy of this book, the Tax-Free Income for Life, I'll send you a copy. The caveat is you have to read it. There's nothing worse than sending somebody a book and they don't read it. So make sure you read it. It's an easy read. You can read it in a couple hours. And again, you're going to be very, very motivated, I think, by the time you're done. So you look for that. My calendar will pop up automatically. If you can't find a time, because we are extremely busy, but I did plot out those times. If you can't find a time for some reason, email us and we'll make time to make sure that you're seen. So as I said, I do have webinars every Tuesday morning at 10 a.m. I know you get invitations for that, so feel free to join us. And starting next Wednesday at the same time, 6:30, we are having an advanced class series. Now, again, when I say we, I'm talking about me, not me and Dave. The advanced classes really builds off of the Changing World of Retirement classes that many of you have taken. And that Changing World of Retirement was put together by this fellow here, David McKnight. And David has helped me and others educate hundreds, if not thousands, really, of retirees, and really have made people more prepared for the challenges they face in retirement. So I really want to thank David for that. And I want to start by telling you how I met Dave. So you may have heard me talk about my involvement with the Ed Slott Elite Advisor Group. And many of you, if we were in a classroom structure, I'd say, has anyone ever heard of Ed Slott? And surely some people will raise their hands because Ed's the IRA guru. I don't think anybody can argue that. So anytime the Wall Street Journal has a question, CNBC, anyone has a question, they call Ed, or they call one of us who's involved in Ed's group. So in 2011, I was a newly minted CFP, Certified Financial Planner. So it took me, I'm not embarrassed to tell you that it took me about 3 years to finish the course of study for the CFP because I'm a working guy. I had to work along the way, finish the CFP education and pass the 5 exams it took to sit for the main CFP exam. And the CFP exam is a 2-day, 11-hour exam. 50% of the people who take it don't pass it. So I was feeling really good about myself at that point. And I was more than 10 years in the business, feeling like I knew just about everything. And I was watching a guy on PBS, Ed Slott. Ed's raised millions and millions of dollars for PBS, and that's probably where you've seen him. Flipping around the channels, I see Ed, and he's talking about a lot of things that I was familiar with, but he was bringing them together in a way that was interesting. And I looked him up online, and I saw that Ed was offering a continuing education class in beautiful Newark, New Jersey. So no offense to anyone from Newark, New Jersey on this webinar, but it's probably not one of the top destination places, certainly on the East Coast. But I went to attend this continuing education. I was sitting in the back of the class like I usually do, so I can pop out and get coffee or whatever. And within the first hour listening to Ed, I realized that there was so much I didn't know. I didn't know what I didn't know. And I had missed so much from my clients. So right after that, I got fully engaged in the Ed Slott Elite Advisor Group. Ed's been my mentor now for many years. I'm actually part of the Master Elite Advisor Group, and it's changed everything for me and my clients and my practice. So fast forward to 2014, I guess it was, I was attending one of the required, we have to attend 2 training seminars a year. They're a day and a half, sometimes 2 days. And I was in San Diego, California. And after a break, I came back to my seat and this book, The Power of Zero, was sitting in front of me. And I always love getting a free book. So The Power of Zero is sitting in front of me, and David McKnight shortly thereafter walks in and starts his discussion about the power of zero. And I had a very similar aha kind of moment where I thought, oh my gosh, here we are again, right? I told you a story about the CFP and my aha moment with Ed. And then several years later, here I am again. Wow, this is really something. And we were talking before we started, the power that Dave has, he's got a lot of knowledge, certainly. Ed has a lot of knowledge and all the people involved, but the delivery that Dave has to be able to bring this complex material to an individual to make it understandable and exciting, I would say, to be able to really change your life in retirement. Because don't think for a minute that this information is not life-changing. And I'm not being dramatic in that. When we do, and you may have an opportunity for this, if it makes sense, I'll do a before and after comparison for you. And these before and after comparisons, sometimes the before being how you're doing things today and after being tax efficient, sometimes it's hundreds of thousands or millions of dollars for people's retirement lifetimes or what they pass to their heirs. And that, friends, is life changing. Sometimes it's the difference between having money at the end of your life or not. So it's powerful. So with that, Dave, I want to thank you. I want to officially introduce you. So say hello, please.
Hi.
And let me, folks, before I just open the mic up to Dave, because I've said a lot, I just want to read his bio for you. So David McKnight graduated from Brigham Young University with honors in 1997. You're much younger than me. Jeez, everybody is. Over the past 22 years, David has helped put thousands of Americans on the road to 0% tax bracket. He has made frequent appearances in Forbes, USA Today, New York Times, Fox Business, CBS Radio, Bloomberg Radio, Huffington Post, Reuters, CNBC, Yahoo Finance, NASDAQ, Investors Business Daily, Kiplinger's, Market Watch, and numerous other national publications. His best-selling book, The Power of Zero, has sold over 250,000 copies, and the updated and revised version was published by Penguin Random House. When it was launched in September of 2018, it finished the week as the #2 most sold business book in the world. For 2 consecutive years, Forbes magazine has ranked The Power of Zero as a top 10 financial resource in the country. The book was recently made into a full-length documentary film entitled The Power of Zero, The Tax Train is Coming. When his follow-up book, Tax-Free Income for Life, launched in November 2020, it finished the week as the #3 top-selling business book in the world. Very impressive. Dave and his wife, Felice, have 7 children. So that is David McKnight, and that's the introduction of our webinar. So again, I just want to welcome everybody and welcome David. So David, how you doing after all that?
Good. Yeah, take a breather. That was a long intro, man. I'm ready to, I'm locked in. I'm ready to go.
Good. You got a chance to get up, have a cup of coffee? Yeah, so I think it's important for people to know the background and not just say, hey, this is Dave McKnight. Because really, Dave, teaching the classes, Changing World of Retirement Planning, is a great class. And I know you say it's not, I think you say it's not based on The Power of Zero, but there's a lot of material from The Power of Zero. But we do those evaluations and people come up to us all the time and say, that's the best. I've taken a lot of these. This is the best class I've ever taken. And it is life-changing. Now, some people act on it, some people don't. It is what it is. You know, we do as much as we can as far as education. But I guess one of the first topics we should discuss is, here we are. It's 2020, or excuse me, it's 2021. World's changed a lot. What now? What do we do now, do you think?
Well, if we're talking specifically about how do we situate our retirement assets, we've got to be pretty thoughtful about it, because we know that tax rates went on sale January 1st, 2018. That tax sale has an expiration date, January 1st, 2026. These are historically low tax rates. People don't recognize that tax rates today are as low as we've seen them in our lifetime. I just did an interview with former Comptroller General of the federal government, David Walker. The reason I cite him quite often is because he knows more about the future fiscal trajectory of our country than anyone else on the planet. And he told me, he said, Dave, tax rates, he says, you can take this to the bank. Tax rates will never be as low as they are today. The taxes are on sale. They will never, ever be as low as they are today. And what that tells you is that we have a window of opportunity within which to act. We know January 1st, 2026, unless Joe Biden acts sooner, tax rates are going to revert right back to what they were in 2017, which means that every year that goes by where we fail to take advantage of historically low tax rates is potentially a year beyond 2026, when we could be forced to pay the highest tax rates we're likely to see in our lifetime. So with the chiming of the clock at midnight on December 31st, we now no longer have 6 years within which to shift highly taxable dollars from 401ks and IRAs to the tax-free bucket. We now only have 5 years. So this has all taken on a little bit more urgency. And, you know, how we all take advantage of the next 5 years can tell the tale of how much efficiency we're able to wring from our retirement accounts over time. So I think we're at a pretty important time in history in terms of making sure that we position our assets in a tax efficient way so that we avoid the tax freight train that's bearing down on America.
Yeah, good points. And boy, that window is closing fast. It seemed like when I started doing Roth conversions on a regular basis, like again, 2011, 2012, it certainly had its challenges. When the Tax Cuts and Jobs Act opened, boy, you saw it. We had discussions about it. It really opened up this great window, and I can visualize it every day, just getting narrower and narrower. And you mentioned the Biden administration. And I think that's a really good point. And this is not a political position. David and I have talked about this, but it feels like that window could close a lot faster, right? Do you agree?
Yeah, I think people are lulled into this false sense of security that Joe Biden has said that he will not raise taxes on anybody that makes less than $400,000. By the way, if you do make more than $400,000 and Joe Biden implements what he campaigned on, all I can say is duck and cover, because first of all, your taxes are going to revert back to exactly what they were in 2017, highest marginal tax bracket of 39.6. But he has also promised that for people that make more than $400,000, he will add on an additional 14% tax to attempt to shore up the shortcomings in Social Security and Medicare and Medicaid. So I've done the math on this, Mark. If you live in California with a 13.3% highest marginal state tax rate, with a 39.6 federal tax rate, throw in another 14% for that extra FICA tax that he's going to throw on top of there, and an Obamacare surcharge, it all adds up to about 71% on the margin. So these are tax rates we've seen in the past. It's what they were in the 70s. They were a lot higher in the immediate wake of World War II. So we are sort of marching into a future where tax rates are likely to be dramatically higher than they are today. You may take solace if you make less than $400,000, but I think that you can't take too much solace, because as you and I talked about, Mark, there's a lady by the name of Maya McGinnis, who's the president of the Committee for a Responsible Federal Budget. And she wrote an article back in 2019, which was a very interesting article. I've done a podcast on it. And she basically said that the name of the article is, "Can we tax just the 1% to solve all our financial problems?" And basically what she said was, what if all we did was tax every dollar that people made above $400,000? How high would tax rates have to go in order to simply prevent the national deficit, which is currently at about $1 trillion, prevent that from getting any bigger, growing to 2 trillion, for example? And she basically says that we would have to raise taxes to 103%, which, as we know, is mathematically impossible. So she said that, well, that's not realistic. So let's lower it to 250. How high would we have to raise taxes on every dollar that Americans made more than 250? And it was still an astronomical numbers, something on the order of 80%. So she kept on recalculating the numbers, and she finally got to the point where she said they would have to raise taxes to 40% for any dollar that Americans made above and beyond $50,000 to simply prevent the national debt from growing at a rate of more than $1 trillion per year. Now, grant you, if the national debt continues to grow at $1 trillion per year, we're still going to have huge problems, particularly if interest rates return to where they were in 2003 and the cost of servicing that national debt quadruples or quintuples. So we're not even talking about reducing the deficit or even drawing down the debt. We're simply talking about keeping the deficit at $1 trillion. $1 trillion per year, and everybody making more than $50,000 would have to pony up 40% of whatever they make above and beyond that amount. So for any presidential candidate that says that I'm not going to raise taxes on everybody is just not telling the truth. And so what we're looking at is a situation where sometime in the next 10 years, they're going to have to dramatically broaden the tax base, meaning that everybody that's in the current 10, 12, 22, or 24% tax bracket will have to start paying a lot more tax, or we go broke as a country. But I mean, the math doesn't lie.
Yeah, that's true. So the study group that I'm involved with, every time we look at this, and we probably discussed it at least 2 or 3 times last year. It seems that your average middle-class American is going to have to be in the 40 to 45% effective tax rate pretty darn soon in the next 8 or 10 years. And you say it in your Changing World of Retirement class. And David Walker certainly said it. It comes down to the math. It's a math problem. We say it over and over and over again. So the question is, how do you overcome that? It's scary, and it can either motivate you or make you hide in the corner. But as we have, and we see it all the time. We see people come to us. They've got significant savings in their retirement accounts, sometimes millions of dollars, and now they're stuck with this, right? So that can be a positive thing. I've done everything that we're supposed to do. Everything. I was taught that way when I was at Payne Weber. You remember Payne Weber? Mm-hmm. Payne Weber became UBS, and I went to Wachovia, which became Wells Fargo. I got out of there as fast as possible, but we were taught fund those tax deferred accounts. That's where all the value was, because money grows and you pay tax when the taxes are going to be lower. But the people I can only base on the hundreds of retirees I've worked with. Most people are in a higher or the same tax bracket now, and it's only going to be worse going forward. So as frightening as that is, RMDs, pushing money out, even if they move at age 75, at some point you got to pay the piper. So what do you do, Dave? What are the strategies we should be looking for and telling these folks that are listening to be looking into?
Well, I will tell you that there's a sweet spot in the tax code. Okay, I think it's the 24% tax bracket. Okay, and I'll tell you why. If you're currently in, say, the 12% tax bracket, and you come to me and you say, Dave, I believe everything you're saying. I believe all the experts that say the tax rates could potentially double over time, and then I put together a strategy that bumps you from the 12% tax bracket to the 22% tax bracket. You're going to come back and you're say, Dave, let me get this straight. In an effort to avoid a doubling of tax rates over time, you doubled my tax rate in the short term. That doesn't feel like a great solution to a lot of Americans. But if you're already in the 22% tax bracket, and I say, hey, look, the 22% tax bracket tops out at about $170,000 or so. Why don't we, if you're already in the 22, why not max out your 22% tax bracket by way of a Roth conversion, for example? And oh, by the way, the next tax bracket, the 24% tax bracket, is only 2% higher. Okay, so we would be bumping you from a 22 to a 24, and the 24% tax bracket goes all the way up to about $330,000. It gives us another, $150 or so $1,000 of space. So instead of doubling your tax rate, we're saying let's raise it 2% on the margin, and all of a sudden we now have another $160,000 of shifting space. We pay the tax at 24%, and I'll tell you what, 2030 is going to roll around, and we're going to look back at that 24% tax bracket and say that is the deal of a lifetime. Or conversely, 2030 will roll around and we'll look back and we'll say, why did we not take advantage of tax rates while they were historically low, right? Yeah. So we have to recognize that tax rates in our past have been a lot higher than they are today. In the future, they're likely to be much higher than they are today. So we do have this window of opportunity. When I revised and updated my book, The Power of Year in 2018 through Penguin Random House, I added a whole new chapter. It's called The Tax Sale of a Lifetime, which means, as David Walker, former Comptroller General, says, we will never, ever see tax rates this low again in our life. So if ever we had even an inkling of a desire to start repositioning dollars from tax deferred to tax free, now is the time to do it. I give you permission to not enjoy it. You just have to recognize that paying them at today's tax rates, today versus postponing them until they're dramatically higher down the road is going to be a nice little salve for that, your angst that you're feeling as you're preemptively paying those taxes. But the point is, taxes are on sale and the sale has an expiration date. And every year that goes by where we don't take advantage of the sale means the window grows narrower. We will have to convert more money within that narrower window, which means we're more likely to bump up into a tax bracket that gives us heartburn. So we want to not pay tax all in one year. We want to stretch that tax obligation out over a a series of years so that we can keep our effective tax rate low during that conversion process. And if we let years go by where we're not taking advantage of these low tax rates, it's going to be impossible to take advantage of these low rates while they're around.
Yeah, good point. And I got to tell you, from a financial planning point of view, we're a financial planning firm first and foremost. It's so important to revisit this plan and look at those comparisons every single year, because you forget, and it's hard sometimes to remember that, hey, I'm paying these tax payments, writing this big check every year for a reason. I shared with Dave that I was on the phone with a client, and I think he's probably on the call here tonight. And we're going to a much greater extreme than what Dave was talking about, from 22 to 24. And we're talking about marginal tax brackets here. So the top of the 24% tax bracket was 326,600 in 2020. I think it's 328 and change this year for a married couple filing jointly. This couple in particular, they're both retired or retiring, so they're at a 5% effective tax rate for the next 5 years or so, and then they're going to see increases, right? Because they have to take distributions and they have to take RMDs, and so we're flipping it around the other way, because the risk is 6, 7, 8, 9, 10 years tax rate risk. I want to come back to that, but instead of waiting and seeing, paying the I don't know tax rate risk that all the experts that are paying attention say are going to be much higher, 40%, 45%, 60%, much higher than they are today. Why not fill in that gap that you have now? Because we can manage it now. We know the rules. We know the rules in 2021. They're not going to change in 2021. They might change for 2022, but we certainly know the rules now. So fill in those gaps. And Roth, we know, David, right? You talk about this. There's only those two things in the tax code that are truly tax-free. And Roth is the biggest one as far as moving IRA assets. Anybody can do it. It's just managing the tax code. Tax rate risk, Dave, is something you and I talk about all the time, and not enough people are talking about it. And it could be a life changer for people, right?
Yeah. And you know what? It used to be there were a lot of skeptics. I love to tell the story about how when I first wrote The Power of Zero back in 2014, there was this guy named the White Coat Investor, who's an emergency room doc out of Salt Lake City. And he had a knack for finance. And so he started fielding questions from other doctors. And before he knew it, he was making more money giving advice about finances than he was being an emergency room doc. And so he calls himself the White Coat Investor. He's got a book, he's got a podcast, and people kept coming to him and saying, what do you think about this book, The Power of Zero, The Power of Zero, The Power of Zero? So finally he had to write a blog post about it. Mm-hmm. And he basically reamed me saying that doing preemptive Roth conversions, well, at today's tax rates is not a great strategy, because, and we've had lots of back and forths on this. I wrote a blog about his post, he wrote a blog about mine, and we went back and forth. And I pointed out all of the math that, as it relates to our fiscal situation in our country, and about how tax rates have to go up. You can't print your way out of our problems, because Social Security, Medicare, Medicaid, the biggest drivers of debt, are all linked to inflation. So you increase the money supply in order to pay for it. It increases the cost of all those programs commensurately. So you can't really print your way out of the problem. And so that's sort of where we left things. And finally, last year, as Biden was running for president and laying out his tax plan, he writes a post on Twitter that says, man, if Biden gets elected president, I'm going to have to convert my entire Roth IRA all in 1 year, which, number one, is a terrible strategy. But number two, it's conceding that tax rates today are historically low and that we should take advantage of them. So I wrote a little comment on his post that just said, I'm glad to see you're coming around, and which point he blocked me. But I think that it was an important, admission that the very few skeptics that are left on the financial planning landscape are coming over to our camp. So there's very, very few people that will try to hold forth that tax rates are going to be low moving into the future. And so it's become more of a consensus now. And so the question is, when I do my live presentations all across the country and I ask rooms full of people, how many of you think that tax rates down the road are likely to be dramatically higher than they are today? And every hand in the room goes up. And then I ask that all important follow-up question. How many of you have the lion's share of your retirement savings stuck in your tax deferred vehicles like 401ks and IRAs? Every single room in the hands go, and every single hand in the room goes up, which tells me that there's a disconnect between what people think about the future of tax rates and what they're doing about it. So sometimes we just have to put this information in front of people's noses repeatedly so that they will feel motivated to preemptively pay this tax while tax rates are low, and not simply wait until the IRS forces you to take this money out. Because if they force you to take the money out at a period in time when tax rates are dramatically higher than they are today, then you lost. You get to spend less money than you could have had you acted today.
Yeah. Yeah, well, so I got two comments on that. Then the first one is I love getting questioned by CPAs about the why you're doing Roth conversions, because it's a really easy conversation. I say to them, I've got about 100 reasons that I can show you that why taxes have to increase and must increase in the future. I just want you to give me one reason that tells me why taxes will stay the same or go down. And other than just silly responses. And I'm not, listen, there's a lot of great CPAs I work with and I respect them. And I certainly respect the education they've gone through, but nobody can really give me a viable answer for that. Right. And a great turnaround was, I had a conversation with a client CPA last 2019 tax year. And he said to me that question, why would you be recommending, I think we were doing about $150,000 in conversions for this client for that year. Why would you be recommending paying tax now when you can wait until later, and all the normal answer or questions? And we had a really good conversation about it. He said, well, I guess it's just like hedging risk, market risk, you're taking a portion of it and setting aside. Fast forward to the end of this tax year, 2020, this past tax year, there was a question about the conversion, and I said, loop in your CPA just to get his sign off so we know what's going on. He came back with a recommendation to do more in Roth conversions for this 2020 year compared to 2019, and bullet pointed a lot of the things that we went to. And by the way, I sent him your book after that, right? So that is a convert there, and that's exciting because now it's not just my client, not one person, but the hundreds of people he works with. So that's exciting stuff. And I can't remember my second point now to that, but
it was doubtless brilliant.
What's that?
It was doubtless brilliant.
Yeah. David, you want to pause for a second? We got a handful of questions. You want to just see what we got going on here? All right. Larry, hey, Larry. Larry asks, given the tax brackets are surely to increase, do you think the government will look at Roths in general to the point where it is no longer attractive? Good question.
Yeah, so remember, Roth IRAs bring more revenue to the government today, okay? IRAs bring revenue to the government somewhere down the road by getting people to pay taxes preemptively on these accounts. They get more revenue to fund all of their initiatives today. And so to me, politicians' job is to get elected. So if they were to get rid of a strategy that brings them more revenue today, they would be in some ways hamstringing their own efforts. And so in fact, if you recall, when Roth IRAs first became popular, they gave incentives and Roth conversions. They gave incentives to people to, you could do it in 1 year, but spread the tax over 2 years. These are ways that the government has to try to get you to pay taxes on their terms at today's rate so that they have more revenue today. All we're saying is we're sort of turning that whole strategy on its ear. We're saying, we believe that given the trajectory of tax rates, that by paying them today, yes, you will give the government the money today, but you will be avoiding having to pay those taxes somewhere down the road at higher tax rates. And so I don't think it's likely to go away. I think that in some cases, like they've done with the Roth IRA this year, they may not, for example, index your contribution limits to keep up with inflation. It's been at $6,000 per year for a couple of years now. So I don't see that happening. But I've been surprised by the government more than once. So,
Yeah, and if you remember when they were discussing the changes that came about in the Tax Cuts and Jobs Act in 2017, they were talking about the Rothification of the 401k. So, listen, I'm an elected official, sit on our local school board. That's a government organization. Government works a lot differently, and it's they certainly aren't planners, not financial planners. So the Rothification of the 401k, what that they were trying to push was they were trying to limit, or there was discussion about limiting the amount that a person could contribute to a tax deferred 401k, and they wanted the remainder of it to go to the Roth 401k option. Great for the saver, right? Roth 401ks are just delivery of good stuff, right? You can, or if you're over 50, you can put $26,000 a year in, get that match on the other side of it, but that's all going to grow tax-free in the future. But that's where David's right. Their window, we talk about a short window. Their window is 2 years. The only thing that a congressman or congresswoman wants to be more than higher office is to keep being a congressman or congresswoman. And revenue now is what they want. So Larry, to answer your question, I think it would actually push the other way. Anything that's going to drive more revenue now to Washington is what they're going to be focused on. And listen, it's a real problem. I would not want to be sitting in a chamber of Congress having to make these decisions, because what we should be seeing are big tax increases to cover this. I mean, listen, I had to bite the bullet as a local elected official here and vote to increase taxes for our local school district, because we finally saw, when I was first elected, we would only look at the budget in 1 year. That's crazy, right? You can't do that. We finally, after pushing for several years, we got a 5-year rolling budget. When I saw those projections, I had no choice but to raise taxes, because otherwise we're going to bankrupt the district. So don't hate me for saying that, folks, but I did vote to raise taxes. So Larry, I think I see it going the other way, where there's going to be more incentives to get.
And if I can just add one other thing, we know that recently they got rid of the stretch IRA. Whether you have an IRA or a Roth IRA, think about what happens now when your heirs inherit that. They're going to be forced to, in the case of an IRA, they're going to be forced to draw that down over 10 years. And if you have an heir, for example, that inherits $1 million and it's growing at 6.5% per year, they're going to have to draw down about $130,000 per year every year for 10 years. They're going to have to realize it as income. What does that tell you? That tells you that the federal government needs revenue today. On the flip side, your heirs inherit a Roth IRA. They're going to have to withdraw that money. They won't pay tax, but they're going to have to withdraw the money over 10 years. You say, well, if it's already tax-free, what's the big deal? They want to get those tax-free dollars out of circulation. What are you going to do with the money if you don't need it? You're going to put it into an investment that does get taxed every year. Okay. We want people to take money. If you envision your financial situation as 3 buckets: taxable, tax deferred, tax free, we want the money to flow from left to right, from taxable and tax deferred to tax free. The federal government wants the money to flow from right to left, from tax free to taxable. And so we can implement some strategies preemptively that help us really have control over the taxation of our dollars in the future. But I think what those two tax rulings show, or tax changes show, is that the government needs revenue right now, not 10 years from now, not 20 years from now. They need it right now.
Yeah, and it's not just the federal government. So we spent a lot of time talking about the federal government, and all those points are correct. Standing up in front of the classes a couple of years ago, I would talk about stretch IRAs and say at some point stretch IRAs are going to be gone, and here we are. They're gone. Another thing, in Pennsylvania, Puerto Rico beats us with tax incentives, but in Pennsylvania, qualified IRA distributions and pension payments are not taxed yet. That's going to change. We have huge deficits in Pennsylvania and a huge pension problem in Pennsylvania, and that's going to change. I can't speak for other pension-friendly states, but I can just tell you In my opinion, and talking to my fellow elected officials, in the local and state level, it's got to happen at some point. So these are ways to protect yourself, and the flexibility is key. So David talked about, you pass this on to your kids tax-free, you can draw it tax-free. There's also no RMDs for you with Roth IRAs. So even if you have, you want to take $70,000 out of your IRA or your Roth IRA, well, sure, it's tax-free, but you don't have to take it. You might be forced to take $70,000, $80,000, $100,000 out of your traditional IRA or 401k and pay, I don't know, whatever the I don't know tax rate is at the time, right? So good question, Larry. Lewis asks, when converting 401k to Roth, so traditional, whether it's 401k or IRA, I'm assuming, to Roth, he says you don't pay Social Security and Medicare, right? So the question is, do you pay Social Security and Medicare tax, I'm assuming, while converting to a Roth IRA or 401k? Dave, do you mind if I tackle that one?
Go for it.
So the answer is yes, really. So you don't pay payroll tax, Social Security, Medicare payroll tax, but you will certainly pay tax. If you're collecting Social Security while you're doing your Roth, or while you're doing your Roth conversions, it's highly unlikely that you're going to avoid taxation of your Social Security during that time. So there's provisional income that tracks the amount of your income that applies to taxation of Social Security. And that can go from 0 up to 85% of your Social Security being taxed. It's not taxed at that rate, but that much is being taxed. So it's hard to avoid that. I would say nearly impossible if you're doing any meaningful Roth conversions. Medicare, again, not a payroll kind of Medicare tax, but you got to look out for your Aunt Irma with Medicare. That's income related monthly adjustment amount. So I don't have the figures right in front of me, but I want to say it's 140 or 180,000. I know that's a big spread, and I can look it up while we're talking because I do have a chart right on my desktop. But if you cross over that initial threshold, you'll be assessed more for your Medicare Part B payments. And it can go all the way up to, I think it's $600 or $400 extra. So, so be aware of that. But often, and we analyze this in our financial planning, we're always talking about, is the view worth the climb? We're paying more tax, our Social Security is being taxed. We're paying this IRMA if you're already collecting Medicare. But better to pay it all now when we know what the costs are than what they're going to be later. Because these are the areas where these tax hits are really going to come in, probably sooner than marginal tax increases. More tax on Social Security, more tax on capital gains, certainly, I believe. Maybe increased IRMA. So Lewis, you got to look out for those things because they're the things, especially IRMA. IRMA sneaks up on you, and IRMA takes 2 years to find you, right? So they look back on the conversions you did 2 years ago, and then they hit you. So if you're not planning for that, that can be really upsetting. So
let me just say there's a flip perspective to that. And I see a lot of people that say, Dave, why would I want to do a Roth conversion if I end up paying $200 extra per month for my Medicare? And my answer is this. Let me conjure up an image for you. You're standing on the train tracks and there's a massive freight train bearing down on you. And that freight train is coming in the form of higher taxes. And might I even say a doubling of tax rates. Okay. So you've got a freight train bearing down on you in the form of double tax rates. Yet you refuse to get off the tracks because the act of removing yourself from the tracks might cost you an extra $200 per month. And so it's, in some cases, it could be tripping over pennies on the way to dollars in an effort to avoid, the extra. In an effort to avoid the extra $200 per month, we allow ourselves to get clobbered by that tax freight train that has been, that we've talked about bearing down on America. And so there's a flip side to that argument, and everybody's different. So you just have to work out the math.
Yeah. And if listen, I have a client, we've been doing Roth conversions for this client since probably 2011. So, he was still working, and we've been working on this. He had big IRAs. And we are right now, we keep it, your IRMA for 2020, I pulled up the chart, is for a married filing joint couple, it's $176,000 or less. You pay the $148.50 for your Part B and no surcharge. And then it incrementally goes up, and it goes as high as $504 for the surcharge. That to be that high, you're over $750,000, but we're able to keep it right below that IRMA. That's part of the calculation, but a lot of people push right through it. Now I'll say, and Dave, you probably experienced this too, is that sometimes you really have to be measured of how you take this, because there's a lot of great math behind doing Roth conversions and being tax efficient, but there's also a psychology issue and behavioral finance issue. And some people have a hard time, understandably. Suddenly we're paying more Medicare, we're planning for it. Our Social Security is taxed more. We're paying more tax for our conversions. And sometimes it has to be more of a glide, right? So maybe you don't jump in with a $250,000 conversion. Maybe you do a 50, and then the following year you do 100, and then you really move on. And what I found is that folks who are more reserved in the beginning hit a point, maybe year 2 or year 3, and they say, I get it. Now let's hit the gas. But it has to be, it's really easy for us to sit here and say, this is the math, but it also has to be a plan that you can implement and stay with. Does that make sense?
Sure does.
All right. Iona asks, how does the 5-year rule work on Roth conversions? Dave, do you want to take that?
Yeah. So there's actually a way to access your IRA prior to 59 and a half. You do a conversion, and each conversion that you do has a 5-year waiting period. And so this rule was put in place to prevent people from simply converting their IRA pre 59 and a half and then tapping into the after-tax dollars immediately. So the IRS says, we're going to preempt that by simply saying that, let's say you convert $100,000 at age 55, let's say age 50, and you now have, well, let's say you paid the tax out of your taxable bucket, so you still have $100,000 IRA. They're going to say that you cannot touch that money for 5 years, and that's their way of, preventing people from going into the, going through the back door, as it were. Yeah.
And it's a really complicated rule under 59 and a half. And as Dave said, if you're under 59 and a half and you do a conversion, you actually have 5 different waiting periods. And it starts each one. And the IRS does make it challenging to breach that 5-year rule, because they have what are called ordering rules. So and whether you're over 59 and a half or under 59 and a half, they're the same. But they first look at contribution. So if you needed to take your money back out, they would first look at contributions. So those contributions would come back out to you. They're tax-free. Then they would look at conversions. Conversions come back out to you. That's also tax-free. You've already paid money on that. It's the growth. It's the growth that's taxable. So then it's the growth that is tapped. So if your back's against the wall and you need that money back, those are the ordering rules. Now, if you're over 59 and a half, we still have the ordering rules, but the 5-year rule is so much simpler because everything's aggregated. So if you've had any Roth IRAs for more than 5 years, even if it only has $100 in it, and you're over 59 and a half, you're good. You're good. You don't even have to worry about the 5-year rule. So don't get caught up on that. I talk about Ed Slott, and after our last conference, they developed this chart, and I wish I could pull it up quickly, but they developed this chart that said, something like an easy way to decipher the 5-year rule. And it's this crazy chart with intersecting lines all over. It's just nuts. But if you just remember this, if you're over 59 and a half, it's very simple. You have to have a Roth IRA for more than 5 years. You don't have to stack them. It used to be that we would get very complicated with stacking Roth IRAs. With every conversion, we would do a new account because you could recharacterize if the market dropped, but that's gone too. Recharacterization is gone too. So it can be very, very simple. Good question. Anonymous. That was from Anonymous attendee. I'm sorry. No, that was from Iona. Anonymous attendee asked, do you believe that the federal tax rate will stay in the 20 to 35% range for the next 20 years due to the fact that politicians cannot take the outrage from the citizenry if the federal tax rate go above 40% for middle-class earners, $100,000 a year or less? That's interesting. Did you get that?
I did.
Okay.
You want me to take it?
Sure.
We're not, what we're dealing with here is not a question of whether it's really a math problem. And as time goes on, politicians are going to be constrained by that math. And this is what I'm talking about. Every year that the debt grows and every year that potentially interest rates go higher, there's David Walker makes an interesting point. There are only two things that the federal government is constitutionally required to pay. In other words, it's written into the Constitution that they have to pay these things. The first thing is pensions from the Civil War, union pensions from the Civil War. Well, everybody's dead. Those are paid out. That's no longer on the table. What's the second thing that we are constitutionally required to pay? It's interest on the national debt. We can't really default on the national debt because it violates the Constitution. So we now have almost $28 trillion of debt. As time goes on, every year that goes by, we add more and more debt, which means that the cost of servicing that debt, particularly as interest rates go up, is going to consume more and more of the federal budget. It is not a discretionary expense. It is a non-discretionary expense. And so what's going to happen is eventually it's going to consume the entire federal budget, and politicians, their hands are going to be forced. They're going to have to raise taxes just to be able to make sure that we don't, quote unquote, default on the debt, that we honor the Constitution. And so it's really a math question at this point. It's not a question of, do politicians want to endear themselves to their constituencies? We are long past the point where politicians have the luxury of making choices based on what their constituencies need to hear in order to reelect them. We are we're marching into a future where math is going to drive all of the conversation.
Yeah, I agree. And you talk about it and you mentioned it earlier, Social Security and Medicare. It's a different, if I'm running for Congress and I stand up in front of a group of people and say, we've got a fiscal crisis in this country and we have to make changes to Social Security and Medicare. And I lay out a plan that's a very sound plan, well thought out plan. Nobody has heard anything I've said except for, I don't want my job anymore, or I don't want this job, because somebody's going to come up behind me and say, that bozo wants to cut Social Security and Medicare. So if you think about it from a politician point of view, it's either the third rail of politics, which is Social Security and Medicare, or talking about incremental tax increases for the rich. Then it's defined, well, who's rich? Well, most of the time, the rich person is the person that makes $1 more than you, right? So as long as there's support of the masses of whatever that definition of rich is, they're going to find it. But again, you've nailed it, Dave. It's a math problem.
Yeah. And the interesting thing is, and a lot of people don't recognize this, taxing the rich only gets you so far. If we were to confiscate 100% of the of all of the wealth of all the billionaires in the US, that would run the federal government for roughly 7 months. So that's enacting a wealth tax of 100%, confiscating all of their wealth. It runs the federal government for 7 months. What does that tell you? We can't just tax the rich and solve our problems. We have to broaden the tax base, and ultimately all of us are going to have to shoulder our portion of the debt. It's just an inevitability, and the math bears all of that out. And David Walker famously said, I can give you a 4-letter word that explains why tax rates have to double. It's math.
Yeah. And I've learned from you that David Walker also said that we either have to double taxes or cut expenses in half, or a combination of the two. And as much as I love the Tax Cuts and Jobs Act, we did exactly the opposite, right? We cut taxes and increased expenses.
Yeah.
So
David Walker says we gave ourselves the dessert before we ate the spinach. We were supposed to increase revenue and lower spending. What did we do? We lowered revenue, and we increased the national debt by $1.5 trillion over the next 10 years to be able to pay for those tax cuts. So it was a classic case of eating the dessert before the spinach.
Yeah. So the answer to that question is, there's no way the taxes are going to stay in the 20 to 35% range in the next 20 years. Sorry, anonymous attendee. Robert asks, LERP is fascinating. LERP is a life insurance retirement plan. And David McKnight has a book called Look Before You LERP, another great book. So LERP is fascinating. How does one cover it? Long-term care with LERP when we keep the death benefit low? Really great question, Robert.
Yeah, I mean, LIRPs, what we strive to do with the LIRP is give you a death benefit that provides an impactful amount of long-term care. And just as a primer, for those who are not familiar with how the LIRP works, the companies that sponsor these programs allow you to receive your death benefit in advance of your death for the purpose of paying for long-term care if you no longer can perform 2 of 6 activities of daily living. For example, say you have a death benefit of $400,000, they will give you 2% of that death benefit per month. Let's call it 25% of that death benefit per year, $100,000 per year, every year for 4 years, for the purpose of paying for long-term care. So I think the idea is that you sort of back into, you say, what amount of money would I like to have, would I like to be able to spend in advance of my death for the purpose of paying for long-term care? And then you say, okay, what amount of money would I need to put into that to fully fund that type of a death benefit? And of course, if you die peaceful in your sleep 30 years from now, never having needed long-term care, then someone's going to get that death benefit. So there isn't that sensation of having paid for something you hoped you never had to use, which is the typical feeling people get when they're paying for traditional long-term care insurance. So, and with the money that grows inside that policy, eventually your death benefit bumps up over time. So you might start with a death benefit at $500,000 as a 60-year-old, but by the time you reach age 80 or 85, when you need the long-term care, that might be worth closer to $800,000. So it has a natural inflation adjustment mechanism that's built into it.
Yeah. And I'll say that, I don't want to make this too complicated, but if you're interested in this process of cash value life insurance retirement plan, there is a sense of urgency right now. And the sense of urgency is because the effective policies are built around interest rates. That's how they build these things with life insurance companies. And if you don't know, interest rates are in the toilet, right? They're really, really low. And all the analysts agree that nominal interest rates are going to be low for a period of time. And every year that passes, it's more challenging for these life insurance companies to create viable and profitable life insurance policies. So they get more and more difficult every year. Don't you agree, Dave?
Yeah, there is a little something that they snuck into the omnibus bill at the end of the year. I'm not sure if you've heard that. I just read an article about it 2 days ago. It was sort of flew under the radar. Nobody knew about it. And then they actually opened up the bill and said, wait a minute, they snuck this in. Okay. And basically what they've done is, there's a relationship between your death benefit and how much money you can put into the policy every year. And that's driven by some tables. And basically what they say is, we assume that money is going to be able to grow between 4 and 6% over time. And that's going to help keep that policy in force. And so the relationship between your death benefit and what you can put into the policy is driven by those ratios. Well, now we're in historically low interest rate environments. And it's no longer, they don't think it's any longer, viable to be able to get that 4 to 6%. So what they're doing, whether that's true or not, is a different story. What they're doing is they're saying, okay, we are now going to decrease the amount of death benefit that you are going to need relative to how much money you're putting in. So for example, let's say a death benefit of $500,000 for a 60-year-old allowed you to put in $25,000 per year for 7 years. They're now saying, someone who has that same $500,000 death benefit could now put in $35,000 per year for 7 years. And so what that does is it sort of minimizes the expenses relative to that policy so that your money grows more productively. And so fortunately, I think that's going to offset a lot of the lower interest rates that we're seeing.
Oh, that's great. No, I didn't know that. I appreciate you're telling me that, because that's been one of the things that's been keeping me up at night, as far as having these tools available. So I appreciate that. Thank you. See, I learned something too on these webinars. It's great. All right. Michael writes, I only hear about cutting Social Security and Medicare. Why aren't we talking about cutting spending in all areas of government, particularly defense, to reduce the deficit? Raising taxes and cutting spending worked during the Clinton years. Um, yeah, that would be great, Michael. It's really challenging to get government officials to cut spending. And there's certain areas, and David, I think, is going to talk about the 9 cents that's left. But these areas, government debt, Social Security, Medicare, they're nearly impossible to cut. But go ahead, Dave. You can take the rest.
Back at the turn of the century in 1900, discretionary spending was 94% of the budget. In other words, there was 6% of the budget that they did not have control of. Okay. So if you were to go to a politician and say, look, I think we're spending way too much, they'd say, okay, what should we cut? And they'd actually have the ability to go and cut those expenses. They did not have control over 6% of the budget. So their destiny was essentially in their hands. We're now at the point where 70% of the federal budget is non-discretionary spending. That's spending that they don't have any control over at all. What constitutes non-discretionary spending? Well, anything that they pay for Medicare, Medicaid, Social Security, any of the unemployment disability programs, and interest on the national debt. Okay, so you could try to get rid of all of the pork barrel spending, and even if you eliminate it 100%, it's just rearranging deck chairs on the Titanic. You're not really accomplishing anything until you come to an understanding on how you could fundamentally reform Medicare, Medicaid, Social Security, and pay down the national debt. The scary part is you can always, somewhere down the road, say we're going to dramatically pull back the reins on Social Security, Medicare, and Medicaid. You can do that really at any point. They just have to have a meeting of the minds in Congress. The problem with the national debt is the longer we procrastinate dealing with it, the more unsolvable that riddle becomes. Okay. So because the national debt will just continue to grow and compound, and we're basically, this is money that we're paying for money. This is money that's, how do I put this? We're paying for money that we're renting that's already been spent. And so it becomes an ethical problem after a while, not just a mathematical problem. And so we have flexibility with Social Security, Medicare, Medicaid. We'd have to pass a law to be able to solve that problem. The national debt, you cannot pass a law to solve the national debt. And we're going to get far enough down the road where it becomes unsolvable. And so I don't lose much sleep about over the pork barrel spending. I lose sleep over the fact that we've increased the national debt by $4 trillion this year.
Yeah. And, can you talk about the real cost of the national debt?
Yes. There is a lot of economists say that the real cost of the national debt is on the order of $120 trillion. Because if we were to run our country's accounting books like every other country in the developed nation, every other nation in the developed world, we would have to count on our books what we call unfunded obligations. In other words, promises that we've made that we can't afford to deliver on. That would be Social Security, Medicare, Medicaid. Some economists add all those numbers up and they say the real national debt is not 28 trillion. It's closer to 120 trillion. That's when you add up the national debt, you add up what we've promised to pay for Social Security, Medicare, Medicaid, and the cost of servicing the national debt over time. All that adds up to $120 trillion. But there's a very famous economist by the name of Dr. Larry Kotlikoff out of Boston University. He's the foremost expert in the nation, in the world, I would say, on what we call fiscal gap accounting. What he does is he projects out over the next 75 years what we have promised to pay in terms of Social Security, Medicare, Medicaid, interest on the national debt. He projects out over that same time period what we can actually afford to deliver under today's tax rates. And he says if there's a difference between those two numbers, then your country has a fiscal gap, and that's your true national debt. He says the true national debt's not 28 trillion. It's not even 120 trillion. It's much closer to 239 trillion. And that was before COVID. I'm anxious to see what his new true national debt number is. But this is what we would have to, so we're proud of the fact that our debt to GDP ratio is only 106%. It's actually much closer to 1,000%. The next worst country in the world who does practice true fiscal gap accounting is Japan, and they're only at 250%. So we are 4 times worse than the second place country in the world.
Well, that's just terrible. And I'm going to give a little plug for Dave here, because Dave's got a podcast that he does weekly. It's a weekly podcast. Yes. And if you haven't signed up for it, you should. I listen to it. So I'll honestly say I don't listen to it every week. I listen to it in chunks, because sometimes it's 20 minutes, sometimes it's a half an hour, it seems. But it gives me an opportunity to catch up on it. But you all should listen to it, because that you talked about Kolikoff and a couple other issues maybe 6 or 8 months ago, and that stuck with me. You always have nuggets that stick with you, and that one, first of all, it terrifies you, but you're right on. We just had to start accounting for pension obligations with our own district. And that changed everything for us, because, when I started on the board, our pension obligation was $5 million a year. And now it's over $37 million a year.
Wow.
And it's not changing. We've got a $250 million budget, a lot of employees. I guess we've got 1,100 kids we put through every year, 800 and some employees. That's just a small little microcosm of everything that's going on out there. So again, it's not just your federal taxes, it's your state and local taxes too. I'm just making myself a note, because I'm going to talk about this on my webinar. Great question. Don asks, and this is a great segue, Don. Don asks, so tell me again how I sleep tonight. And that's true, because let's just say that there is good news to this, right, Dave? I mean, we talked a lot about the cloudiness and the problems out there, but I'm going to let you talk about the good news.
All right. I'm trying to read your mind here. The good news that we're at historically low tax rates for the next 5 years.
Yeah, we still have an opportunity.
That's
right?
good news. I mean, yeah, you have the opportunity. Let me tell you a quick story. I think that's apropos to what Don is saying. Back in February of 2020, just prior to COVID, I was given a live presentation, and a lady came up to me at the end of the presentation. She said, "Hey, Dave, thanks a lot." I said, "What?" She says, "Now I'm in a really bad mood." I said, "Why are you in a bad mood?" She says, because I've got all my money in the tax deferred bucket. I said, "Let me see if I understand you correctly. You contributed to your tax deferred bucket at a period in time when tax rates were dramatically higher than they are today. You got a deduction at those higher rates for doing so. You now have a 6-year period of time during which to take advantage of historically low tax rates. So you can get all those tax deferred dollars systematically repositioned to tax free, so that by the time tax rates potentially double over time, you've done all the heavy lifting. You can now take that money out tax free." I said, "Is that why you're in such a bad mood?" And she says, "Well, gosh, Dave, I never really thought about it that way." So what's the moral of the story here? So long as we take advantage of the next 5 years of historically low tax rates, then
I'm not sure if I froze or Dave froze. Can someone raise their hand if they can see me? Thank you very much. All right. So it seems like Dave's frozen. I'm going to just shoot him a text and let him know. Yeah. Thanks, Don. So just bear with me a moment. It could be the internet in Puerto Rico. I don't know. But he's right. We do have that window of opportunity to get these Roth conversions and other tax efficient planning done. We just lost him. I'm sure he'll log back in. There is an opportunity. Better to be having this conversation here in 2021 than to be looking back in 2030 and say, I missed an opportunity. It's almost like having an ability to buy Amazon, 10 years ago or pick one. Don, you should be sleeping well, because we have a really good plan, and that, and you're one of the lucky folks who can get to the 0% tax bracket. So, and that's the goal. Not everybody can do it, but you can get to zero. You can leave money in your IRA if it works for you, where you can take money out and with tax deductions that can be tax free, and that's different for everybody. You got enough money in your Roth IRA, so distributions are tax free. And if you're fortunate enough to get approved for a life insurance retirement plan or a cash value life insurance policy, whatever you want to call it, then distributions from there can be tax free if they're properly structured. So that's really important. Let me just check in with Dave. Just pause for a second, and I'll let him know, and that he can log back in. All right. All right. Well, we'll just keep going because I have a cell phone in my contact manager, but not on my cell phone. Here he comes. So Dave, we lost you there for a minute. So we'll give him a minute to come back.
I'm here.
Yeah. So I finished your thought for you, if you don't mind. And I reminded Don that Don's got a great plan that actually gets him to zero. So he should be sleeping well, but it was a great segue, Don. Thank you. So just a couple more questions. Robert's getting all his questions in. He asked, does my income from Roth conversion count towards 189,000 income limit to contribute additional money to a Roth? So what Robert's asking is, does the income, the taxable income from the Roth conversion affect his phase out to be able to contribute to a Roth IRA? And I don't know if you want me to take that or you take that, Dave.
Yeah, it does not. But part of the every year we get updated on thresholds and things like that. The new threshold is 198,000 to 208,000. So as you move through that $10,000 range from 198 to 208, then your ability to contribute to that Roth gets reduced proportionately. So the answer is no on the first question, and then just a tiny tweak on the income, the modified adjusted gross income threshold that determines whether you can contribute to a Roth IRA or not.
Yeah. And that's Roth IRA. Roth 401k does not have those same income limitations. So that's why they are so valuable. So if you don't know if you have a Roth 401k, ask your employer. And I would say, if you don't, lobby your employer, because your employer is probably going to love you for it in the end, because they're highly compensated individuals typically, and they may not realize that they can put more money in on a tax-free basis, future tax-free basis. One more question from Robert. You're getting all your questions in, my friend. Will my stimulus check received in January 2021 be affected by my income level in 2021? Concerned as I want to do a Roth conversion this year. Well, it's going to be check. I'm going to caveat this by saying, make sure you check with your CPA or tax planner or tax advisor. But it's going to be taxable income, your stimulus check. So it's going to affect it's going to fill up that graduated cylinder, as we like to refer to it, as taxable income, unless there's something I don't know about that, Dave. But
what you've said is what my understanding is, and I don't have anything else to add to that.
Okay. Let me just see here. So you talked about the changes under the Biden administration and the Democrat-controlled Congress, and what the plan is, what the sketched out plan is. And one of the big changes are 401k, affect 401ks. Do you want to talk about that a little bit?
Yeah, this is a really interesting thing that Joe Biden floated while he was campaigning, and it'll be interesting to see. The first 100 days of a presidential, a new president's tenure is critical because it sets the tone for the rest of his 4 years. And Joe Biden has a wish list, and he's likely to go after it right out of the chute, knowing that if history serves as a model, he's going to lose majorities in the House and the Senate at midterms. So he's going to be pretty aggressive coming out of the chute in trying to fulfill his wish list. One of the things on that wish list, if what he campaigned on is true, is he wants to fundamentally reform how deductions work with your 401ks, 403bs, so on and so forth. Currently, what happens is if you are in, say, the 37% tax bracket, and you contribute $10,000 to your 401k, you save $3,700, right? At least at the federal level. If you make, if you're in the 10% tax bracket and you contribute 10,000 to your 401k, you save $1,000. So basically, Joe Biden's view is that the difference between tax savings between the guy that's in the 37 and the guy that's in the 10% tax bracket, he thinks that's fundamentally unfair. And so what he is moving to do is to make a standard sort of a deduction for whatever tax rate you're in, and the revenue neutral amount where it doesn't require more taxes or less spending, where it's just revenue neutral, they say is around 26%. So in other words, someone who is in the 10% tax bracket puts 10,000 into their 401k, they would save $2,600. The person that's in the 37% tax bracket contributes $10,000 to their 401k. Instead of saving $3,700, they save $2,600. What that tells you is that if you are in a 24% tax bracket or lower, it's going to really pay to contribute to your 401k. It tells you if you are in the 32% tax bracket or higher, it's going to pay to do a Roth 401k, Roth IRA. Well, really, we're talking about 401ks, those types of qualified plans. So Roth 401k, it does not make sense at all to put money in that pre-tax account.
Yeah. Another way they're gonna, these things are gonna come in the side door. We did touch on capital gains a bit, but do you want to speak more about that under the proposed changes?
Yeah. So one of the big changes on capital gains is he wants to change it from for people that make over a certain amount of income. I think the threshold's $1 million. He wants you to pay short-term capital gains as opposed to long-term capital gains. But another really big one is he wants to remove the step up in basis, where people currently, you have $1 million of stock in Apple that you bought at $500,000 and you die and it's worth $1 million. Your kids inherit it. Their basis gets stepped up to the value at your death. So it's now $1 million of basis, and then you pay tax on any growth you experience moving forward. He wants to eliminate that so that heirs inherit the tax basis of their parents. So for example, in that scenario I described, your heirs would have $500,000 of tax basis. So when they sell that stock, they're going to have to account for that growth and potentially have to pay that at ordinary income tax rate. So there's a lot of things that are happening that could fundamentally change the tax landscape. And so if Joe Biden is going to make it happen, you're going to start hearing about it in the first 100 days.
Yeah. And that's enough. You can't, so when you're talking about stepped up in basis assets, you can't contribute those, or you can't convert those to Roth IRAs, but we often talk about that's where we use the life insurance, right?
Right.
You want to talk about a little bit about shifting that money over?
Yeah. So there's only so many places that you can put money in tax-free environment if it's coming from the taxable bucket, right? If you have money in an IRA, you can always shift 100% of that to a Roth IRA, no problem. But if you have $1 million or even $500,000 in your taxable bucket and you want to protect that from the impact of rising tax rates over time or changes in the tax code, one of the things that's unique about the LIRP is there are no contribution limits. There's no income limitations. It doesn't have those Roth modified adjusted gross income thresholds that phase you out. So there's no, like I said, there's no income limitations. There's no contribution limits. So I have clients that do $50 a month into their LIRPs, and I have clients that do $200,000 per year and everywhere in between. And so it becomes a very flexible tool in terms of sheltering some of those otherwise highly taxable assets and moving them into a tax-free environment.
Yeah. And I'll tell you, I'm working on a plan for someone right now that is really interesting. I'll just share with you briefly, because if you have, and folks have these highly appreciated assets in their taxable accounts, whether it's stocks, bonds, cash. Well, cash doesn't really appreciate, but whether it's stocks and bonds or real estate, closely held businesses, things like that, there's a way to shift to borrow money on those assets and use that to fund the life insurance premium. And then you basically get to pass those assets under the current law with a stepped up basis. So that's tax advantage for your heirs. So if you got $1 million or more in investments or real estate or something like that, and you, God forbid, pass today, your heirs receive that for the value that it's assessed at today, as opposed to what you bought it at. And then through time, you fund a life insurance policy, and your heirs also get that. So it's really a great scheme to be able to move a lot of it. Does that make sense, what I just said, Dave? That is a really great scheme. So if anybody has that kind of situation, I'd love to talk to you about it. But that gets really exciting. You know, we're helping somebody with a pretty big real estate portfolio who was in a situation where he's looking to have to sell it, and instead he can leverage it and purchase a nice life insurance policy for his heirs. And by the way, then the real estate passes at a stepped up basis as long as it stays there. And you know, this isn't tax avoidance. It's not. You know, we always talk about we're paying tax, right? It's just taking advantage of the tax code that we have while we have it. We should also just touch on estate tax. Now, I don't know of any plan in the Biden plan to affect estate tax, but as I'm looking at my updated tax planning chart, the exemption for estate tax is $11.7 million per individual, right? So a married couple, that's times 2. If I were a betting man, I would bet that that's going to come down, right?
Yeah, and I could have sworn, Mark, that I saw a Biden proposal somewhere along the line that talked about it being in the $4 million per person range.
Mm-hmm.
So we're talking coming down from 23 million and change down to 8 million and change. And while that may not affect everybody on this call, it's going to affect a lot of people. That's particularly when we're talking about paying an estate tax. You could pay a state estate tax and a federal estate tax on anything above those exemptions, which can be really catastrophic if you're forced to liquidate a business or a farm or what have you. So there's a lot of interesting tax developments coming down the line.
Yeah, and just not to make it too complicated, but you know, if you don't have your business valuations, things like that, the taxing authorities are the ones that get to determine what your business is worth. You know, they say what your business is worth, and it's up to you to fight it. So if you think about that, if federal estate, death tax comes down, it used to be when I started, it was $650,000. You remember that, right?
Oh yeah.
That's a low threshold. Up to $1 million, that was a hallelujah moment. But then with 5, and now we're up pretty high at 11. 40% for federal government here in Pennsylvania from $1, it's 15%. So now that's 55%. If any of that is IRA money, it's going to be taxed at 39.6, 37. Well, you're well into the 90s there, right? And that is not insignificant.
Yeah. Ed Slott wrote a book called The Retirement Savings Time Bomb and How to Diffuse It. And this is back when the estate exemption was really low. Mm-hmm. And he says there's a blurb on the back that says the federal government is waiting to confiscate 80, in some cases, 80% of your IRAs. And so, he spends the rest of the book talking about how to avoid that. But when you add up all of those taxes, there could be next to nothing left if you are sort of caught flat-footed.
Yeah. 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 So again, it sounds doom and gloom. Here's the thing. It's important that you are paying attention to these things, that tax rate risk that unfortunately not enough of my colleagues are talking about. We're not trained that way. We're just not. You've got, and this was what I was thinking about before, Dave, that had escaped me, but the Wells Fargos of the world, the UBSs of the world, Merrill Lynch, Morgan Stanley, they're trained, even Vanguard, Fidelity. I'm a big Vanguard fan, Fidelity fan. They're trained to gather assets. That's what they considered the people who sat in the chairs did what I do. The majority of my training in those big firms was how to bring in new clients and new money, right? Asset gathering, not tax efficient planning. One of the reasons I joined the Ed Slott group is because I have a panel of experts that I can email or pick up the phone and ask them very complicated questions, tax planning questions. And I've never been able to stump them. I've never had that at any of those big firms, UBS, Payne Weber, Wells Fargo, Wachovia. I got crazy answers or just blank stares when I would ask questions before. So I'm not trying to be derogatory. I'm just telling you the truth. So you're not the reason I tell you this is that these big firms is where the majority of the financial advice comes from. And that financial advice is driven by bringing more money in, whether it's somebody trying to sell something for a commission at one of the big firms, or whether it's Vanguard just trying to bring in more money because they get paid by percentage points, although they're low. That's what, and they have to have massive amounts. That's what they're driven by. It's not about how to effectively shift money from tax deferred to tax free. And in fact, Dave talks about this in his book. It's actually conflicting. If I would have gone into my manager's office at UBS or Wells Fargo and say, hey, I got a great thing to do for clients, and we're going to start moving millions of dollars every year into the Roth IRAs, and we're going to have to pay some of that in tax, they'd say, get out of my office, kid, because your job's to bring in more money, not send money out. Right. So the good news is this, is that from this webinar tonight, and we're almost at 8:00, so I'm going to let Dave go soon. From this webinar tonight, the weekly webinars that I have every Tuesday, these books that I'll send out to you if you meet with me, take advantage of that consultation if you want them, and you promise that you'll read them. I'm happy to send you a book. The training webinars, the classes that we have, I have the advanced class series starting next Wednesday. You should be sharing this information with the people who are close to you, because really our job is to get this message out to as many people as possible, because there's not enough of us doing it. There's only 400 of us in this Ed Slott Master or Elite Advisor network. And that shocks me. There's a lot of you baby boomers out there, Many of you on the call tonight are baby boomers, and you need this kind of help, because 10 years from now, you're going to look back and say, geez, Louise, what did I miss? Right. As we log off, I want to thank everybody. I'm just going to check to see if there's any additional questions. I want to thank everybody. I'm going to give David a chance to just close for us. And as you shut down and log out of the meeting, my calendar will populate, and you'll have an opportunity to schedule time with me. If you can't find something on the calendar that fits for you, there's a few windows that I have over the next few days and in the next week. But if you can't find something, just send us an email and we'll make time to see you for sure. It's easy for me to stay here late because, I'm working from home. So Dave, you want to wrap up for us?
Yeah. And I'd love to put a good word in for you, Mark. Mark is one of our top advisors. He's part of our group, and he's one of our lead advisors, and very impressed with Mark's knowledge, his level of expertise, and his professionalism. So in the state of Pennsylvania, I'm trying to think of if we have any other advisors that are as well equipped as Mark to be able to deal with these types of issues, and none really come to mind. Mark is really impressed with Mark and the job that he's been able to do. And as many people as he's been able to help since I've known him, it's very impressive. And so I just, maybe leave you with two thoughts: that you're in good hands with Mark, and really don't let a single year go by where you're not taking advantage of this tax sale of a lifetime, because it really is an opportunity. Once that window shuts, it shuts forever, and you don't want to have any buyer's remorse. What's the opposite of buyer's remorse? Feeling like you missed the window of opportunity, any regret, I suppose, looking back and saying, man, I could have taken advantage of tax rates while they were at historically lows, and now I'm stuck at double the tax rate. So you just don't want to have any of that regret of missing this window of opportunity.
Great. Well, thank you, first of all, for those kind words. Dave, I consider you a great colleague and a friend. We've gotten to know each other pretty well over the past few years, and I appreciate all the work you do. I really, one of my goals for the past few years is to write a book. And every time I read one of Dave's, I think that's exactly what I wanted to say. So I appreciate you doing my work for me.
Absolutely.
This has been a lot of fun. I'm sure we'll have you back in a few months, because we want to keep everything up to date. And I appreciate everybody for spending time with us tonight. And I hope you have a great night and a great remainder of your week. And if I don't see you beforehand, we'll see you next Tuesday. And then our advanced classes start next Wednesday. Good night, everybody. Thanks again, Dave.
Yep. Thanks, Mark. Bye.
Bye-bye. Hello again. I hope you enjoyed the video, and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.